Inflation is a key economic concept that has significant effects on both micro and macroeconomic levels. It refers to the general increase in the price level of goods and services over a period of time, leading to a decrease in the purchasing power of money. While inflation is a normal feature of a growing economy, its effects can be both beneficial and detrimental, depending on its rate and the context in which it occurs. This paper will explore the role of inflation in the economy, the different types of inflation, its causes, consequences, and the policies designed to manage inflationary pressures. Number 1. What is inflation? Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of money. It is commonly measured by indices such as the Consumer Price Index or the Producer Price Index, which track changes in the cost of a basket of goods over time. A moderate level of inflation is typically seen as a sign of a growing economy, but excessive inflation or deflation can signal economic instability. Application: in periods of low inflation, the value of money remains relatively stable, allowing consumers and businesses to plan and invest with more certainty. On the other hand, hyperinflation can erode savings and create uncertainty, while deflation can lead to economic stagnation. Number 2. Types of inflation: demand pull and cost push. There are two main types of inflation that economists generally recognize: demand pull inflation and cost push inflation. Demand pull inflation occurs when demand for goods and services exceeds the economy's ability to produce them, leading to upward pressure on prices. Cost push inflation, on the other hand, happens when the costs of production increase, causing firms to raise their prices to maintain profitability. Application: demand pull inflation is common during periods of economic growth when consumers and businesses increase their spending. Cost push inflation often arises when there are disruptions in supply chains, such as increases in raw material costs or labor shortages. Number 3. The role of central banks in controlling inflation. Central banks, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, play a crucial role in managing inflation. By using tools like interest rates and open market operations, central banks aim to keep inflation within a target range. Raising interest rates makes borrowing more expensive, which reduces spending and helps to control inflation. Conversely, lowering interest rates can stimulate spending and investment, but may lead to higher inflation if not carefully managed. Application: the Federal Reserve's decision to increase interest rates in response to rising inflation in 2022 reflects how central banks use monetary policy to combat inflationary pressures. However, these decisions must be balanced to avoid triggering a recession. Number 4. Hyperinflation. When inflation goes out of control. Hyperinflation refers to extremely high and typically accelerating inflation, often exceeding 50% per month. It occurs when there is an excessive and uncontrolled increase in the money supply, often due to poor government, fiscal policies, or loss of confidence in the currency. Hyperinflation erodes the value of money at an alarming rate and can destabilize economies, leading to widespread poverty and social unrest. Application: historical examples of hyperinflation include Zimbabwe in the late 2000s and Germany during the Weimar Republic in the 1920s. In both cases, uncontrolled printing of money led to a collapse of the national currency, making it nearly worthless. Number 5. Inflation and its impact on purchasing power. The most direct effect of inflation is the reduction in purchasing power. As prices rise, each unit of currency buys fewer goods and services. For consumers, this means that their standard of living may decrease unless their income rises at the same rate as inflation. This effect can be particularly harmful to fixed income groups such as retirees whose pensions may not keep pace with inflation. Application: in countries experiencing high inflation, wages may not rise fast enough to compensate for increased living costs, leading to a decrease in consumers' real income. For instance, in countries with double-digit inflation, the real value of savings can diminish rapidly. Number 6. Inflation and interest rates, a complex relationship. Inflation has a significant relationship with interest rates. When inflation rises, central banks may raise interest rates to cool down the economy. Higher interest rates make borrowing more expensive and can reduce demand for goods and services, helping to bring inflation under control. However, this also increases the cost of financing for businesses and consumers, which can slow economic growth. Application: in 2022, as inflation rates surge globally, central banks raised interest rates to combat rising prices. This move can help control inflation, but may also result in a slower economic growth as businesses and consumers reduce spending and investment. Number 7. The effects of inflation on investment. Inflation affects investment decisions in an economy. In periods of high inflation, the real value of returns on investments can be eroded, leading to uncertainty among investors. To protect against inflation, investors may shift their focus toward assets that tend to retain value, such as real estate, commodities, or inflation-protected securities. Application: during times of high inflation, investors often turn to precious metals like gold or commodities like oil, which are seen as hedges against inflation. Similarly, stocks of companies in sectors such as utilities or energy may perform better during inflationary periods. Number 8. Inflation's impact on wage growth and labor markets. Inflation can put pressure on wage growth, especially if it outpaces productivity gains. As the cost of living rises, workers may demand higher wages to maintain their purchasing power. However, if wage increases are not matched by productivity gains, it can lead to a wage price spiral, where higher wages push prices up, which in turn leads to further wage demands. Application: in countries with high inflation, labor unions often negotiate for higher wages to keep pace with rising costs. If wages rise too quickly, however, it can contribute to further inflation, creating a difficult cycle for policymakers to manage. Number 9. Inflation and income inequality. Inflation tends to exacerbate income inequality. The effects of inflation are not uniform across the population. Wealthier individuals may have assets that appreciate in value during inflation, such as real estate or stocks. In contrast, lower income individuals and those on fixed incomes may experience the brunt of inflation through higher prices for everyday goods and services. Application: during periods of high inflation, wealthier households may benefit from rising property values or higher returns on investments, while low-income families may struggle with increasing prices for essentials like food, gas, and rent. Number 10. The relationship between inflation and economic growth. Inflation is often viewed as a trade-off with economic growth. Moderate inflation can be a sign of a healthy, expanding economy, where demand is rising and businesses are growing. However, excessively high inflation can hinder economic growth by creating uncertainty, reducing investment, and distorting price signals. Conversely, deflation, a decrease in the price level, can signal economic stagnation, which can also undermine growth.